To the option-implied predictive information for the spot market. Here I show you just a time series for Bakshi volatility across different maturities. Right? So you can go through that. But what we see, vol is persistent. We also see I could use a low dimensional factor structure to model that. I also see there are spikes during crisis times, like your COVID option vol for the index jumps to 120%. 2008 financial crisis, it jumps depending on maturity between 60 and 100%. I can also plot kurtosis to the question, is it Gaussian? No, clearly not. You see kurtosis is clearly not constant at 3. Also, it moves across time. I could also model that with a low dimensional factor structure. I also see it has low correlation with implied vol. Here I plot the density for that December 1st, 2003, which we construct for different maturities. So it might look Gauss, but just because the resolution is the way it is. Because if we go 2003 at 23, it's here. And okay, kurtosis is low. What about vol? I didn't plot skewness here. Okay, yeah, but there's nothing in the code that makes the density be Gaussian. Okay, so as a summary, these are forward-looking densities. So the maturity coincides with the forecast horizon here. But we already saw here different maturities can be used as proxies, or maybe we take a PC. It depends on what we want to do with it. Yeah? I just show you the data, anticipating it's the first time you see that. So you should then also feel free to interrupt me if something is urgent. So we compute these densities based on today's out-of-the-money calls and puts. The shape looks pretty nice, given that the option quotes are kind of noisy, not too noisy. That's why I'm quotation mark. So I talked about how we smooth before we compute the density. And now it's kind of ready to do anything we want with that density. We could use it, mean variance. A big thing I want to do moving forward, not in this course, but maybe at the end of the course, it's planned, but just in research, is to use that for reinforcement learning. Because in reinforcement learning, you kind of mimic a person who has to make decisions in real time and at a millisecond frequency. And using time series data to make forecasts is not very promising, but if we can take the density from option contracts in high frequency, I have a proxy for the density in high frequency. It might be biased, that's okay, because within the reinforcement learning, there will be room for adjusting for that bias, yeah? But at least I have information about what could happen and with which probabilities. Okay, and the point is, if you work on your thesis, project or master bachelor thesis alike, you can work with our database. People who have been to the Förderverein meeting, there we had the best paper thesis award, and these guys were working on this, but in higher frequency. So we have an algorithm, it was talked about, where we use the Kalman filter to make predictions of the entire vol surface given the observation of a few quotes. This works very well. We didn't yet have not been able yet to put it in a research paper. We thought also it's too good for a research paper in terms of innovation potential, because there is nothing of that kind in industry, at least. I mean, we don't know what Renaissance technologies have, but from what we can see, there hasn't been anything. But now we will step by step make it available to literature. Okay, so this kind of ends my big picture. So if we have to leave the room, I think I revealed all the information I wanted to reveal, but we have more time, and therefore I kind of revisit nearly all of the points a second time. Okay, so with different data. Yeah, so here you see implied vol surface of the Euro Stoxx 50 for November 28, 2007. You have a few similarities. First of all, we see if we have a lower strike, implied vol seems to be higher. That's this volatility smile or skew. Then if we fix the K, we have a term structure, and it could be upward sloping, like here for high strikes, but could also be downward sloping. So I wouldn't memorize that in any way. It's a pure data-driven thing, but here you see kind of can have all types of shapes. Here in red, just from a modeling perspective, the most difficult to model are these very short-term, deep out-of-the-money put options. So they are very difficult to model with the parametric model. We had a dissertation on that as well. Last year it was finished. And what you need is you need the underlying ST. You need to model that to have jumps in return. And also the volatility of ST has jumps. Yeah, so you need a lot of these jumps in order to explain why an investor would be so scared of these highly improbable downward moves that he's willing to pay so much for it. Okay, but this is what we see in the data, so this is true. And then it gives us just insights how to build models and the like. But today it's not about model building, it's about translating that into the density and then having a predictive information moving forward. Okay, so the Black-Scholes model is used to compute the implied vol from price. So you might wonder, but it's not the true model, which is correct. Black-Scholes is a simplification, but still every trading desk is using the Black-Scholes model to compute implied vol. If you take your own model, then the vol will be slightly different. So it's good to speak the same language with another trader, right? And therefore, this is the norm. Okay, now there are a few arbitrage constraints on the vol surface. So one thing is the volatility sigma must be positive or non-zero. Non-negative, which is fine also from statistics. There should be no problem at all. Then that's an interesting thought. The volatility skew cannot be too steep, as it always must hold that K2 larger than K1 implies that the put price of K2 is also larger than the put price of K1. Now you, as the data science applicant, doesn't have to bother about that. It's just when we did build a database, we had to ensure these constraints hold. And then there's another one. The term structure cannot be too inverted, as it also must hold that the call price is rising in maturity. Okay, again, for you as the applicant, it's fine. We, as the data provider, we made sure that these constraints are fulfilled in our database. Now I want to move on to what are reasons for this volatility skew. Yeah? And so I just took that from some industry research, the summary. So here what you see is the time series of the stock price prior to the 1987 crash. So this is kind of the first crash where we also had options traded. So we had a 1%, within a day, we had a 22% drop. If you keep in mind, there's a 1% standard deviation roughly. So this is like a 20 standard deviation event, or 22. So let's say 20. So it happens, going back to the calls, to the puts, why is someone buying or trading, selling a minus 23 normalized moneyness put? I mean, these things happen and you want protection. But prior to 87, people didn't care so much about that protection since they were not aware of that crash to be possible. But in 87, it happened, and I have an upcoming picture. What happened was, before 87, the volatility smile was rather flat. Yeah, we had maybe something like this. And after 87, it's more like this. So you really see this is demand from investors for protection. Which also means that these left tail density elements are highly informative, because these guys want protection, so they have something in mind. Yeah? Because if I talk to other managers, they're like, protection costs money. Of course, you have to pay for the put option. And they want to create alpha. So if you have too much protection, you'd never get alpha. So for them, it's really a trade-off, and they would go into the protection if they think there's something really coming up. Okay, so in terms of the reasons for this vol skew, if we want to build some theory around that or some intuition, there are two things. One is in terms of risk aversion, the other one is in terms of the leverage effect. So for risk aversion, I made the decomposition into ABC. Yeah, so one thing you might hear is, or you might say to someone, is that stocks, let's say differently, if the volatility smile was a constant, yeah, so it was not existent. This is implied vol, and here we have K. If it was constant, it would mean the Black-Scholes model would be perfect, yeah? Because you have one volatility which is priced into all option contracts for different strikes. But if the underlying doesn't have a constant vol, if the underlying has what I just mentioned 3 minutes ago, if you have jumps in the return, jumps in volatility, then it will naturally generate a volatility smile or smirk. Yeah? So I think this is something to repeat and to think about once again. Let's say you have the possibility of a jump, of a downward jump in return, like a minus 30 standard deviation jump. That is a probability, it's positive, so it could really happen. Therefore, there is more tail probability mass in the left. Therefore, put options become more expensive because they are trading basically that probability mass if you have a deep out of the money put option. And that then translates into higher implied volatility for these options. Or you can have jumps in volatility. It's the same thinking. Now the other thing for risk aversion, why is this risk aversion? Because the investor might be risk averse with regard to these down jumps, and then in addition charges a risk premium for that, which also gives you that smile. Now the other thing is here, as the market goes down, fear sets in and volatility goes up. That's an empirical pattern. And another one is about supply demand, which I've used already in one of the arguments, that equity investors like to protect their long portfolios in S by these cheap, dollar cheap out of the money puts, deep out of the money puts. They just cost a few cents. And this raises the demand for these options, and therefore, relatively speaking, they become overpriced in terms of the implied volatility. Okay, another thing is leverage effect, which you sometimes hear. So I put a thing here. Now the first bullet point is about how to model that theoretically, which we don't do. So I'm just repeating it, what I've been written down here. So the total value of a company has two parts. You have debt and you have equity. And there's a theory where you model debt plus equity as a geometric Brownian motion, so as a log normal distribution. And if you do so, you can then invert out how the value of equity moves. And here's a rationale which I kind of liked, but you see the red ones is what I'm after in the interest of time. Go through that yourself. The idea is if you ask yourself, it's V plus delta V. Yeah? So this is the value tomorrow relative to today's value. So it's the return in the value of a firm. And you can write that as the return of equity plus the return on debt. And if you factor things out and you assume that the debt component is small, then you have this relationship that the volatility of the firm, so the left-hand side here, depends on the volatility of equity times E over V. And therefore, if you solve for sigma E, you have this inverse relationship that if E drops, so if the stock price is equity, yeah? If the stock price drops, naturally the volatility of equity becomes more volatile. So I think this is just interesting to see that there is this mechanical relationship that if the equity drops, its vol goes up. And that could be another reason for this implied volatility, for this smile or smirk. Yeah? Because to the left we have drops in equity as the strike is very low. Okay, yeah, so punchline is just there are different reasons of why volatility seems to be rising if the equity price drops. Okay, now here's something, wasn't sure to put it in or not, since I can't derive everything here, but I put it in to activate a node in your brain that might come in useful at some point in your future life. And here's what it does. So far, I've been going from implied wall surface towards the density. And now I want to activate the neuron that if you trade options, you are really trading a specific quantile of the distribution. This is I have to repeat it, it's a big thought. You heard me saying that already when I said you are trading probability mass here. And I like this example for that. So let's just start. Now, there's a portfolio strategy for options which is called butterfly. Yeah? And what is a butterfly? A butterfly would go long a call with a strike k minus delta k. It goes long another call on the same underlying, same maturity, but the strike will be placed at k plus delta k. Yeah? So you're bullish basically on k minus delta and k plus delta. So already kind of intuitively, if you're bullish to the right and to the left, let's complete the intuition, and then you are short 2 calls with a strike of k. Okay. So the value of the butterfly strategy, this is B0 at time 0, the value, is therefore the value of this one call plus the value of the other call, and then you're short 2 times the call with a strike of k. So therefore that strategy has a value, B0. And using a few approximations, maybe, I'm not sure. I think I go back to since time is a problem here, and not doing it, but I can't yet because we haven't done all the analytics necessary. So you see, I'm now fighting with myself here. Let me just go to the insight first. That's what we need because it's about financial data science, and I just want to give you the insight. The insight for data work is, you see, if B0 is rising, let's say B0 goes up by 10%, so your call portfolio, the butterfly position has increased by 10%. Why did it go up? And one can show with these different approximations that the value is basically just e to the minus r, so that's not interesting. Delta k is also not interesting. These are constants, determinant. They're constant. They cannot change across time. So the only thing that can change really to make B0 go up by 10% is this f, kt. And approximately what that stands for is the probability that, the probability bars of k. So therefore, whenever I say if I buy this very cheap out of the money put options, I'm doing that because I'm trading that probability here. That's what I said several times. And now with the butterfly strategy, I like, that's why I put the basket around it and into the slide, is that even though you are investing in such a butterfly strategy, I have never done it, but we had once a project with students where we asked what are typical option strategies, and then I took this Eurex certificate thing, and there are maybe, I think in the last class I had a few of these strategies, like a condor, a butterfly, and whatnot. So there are maybe a straddle, maybe 6, 7 different strategies. And it's just interesting to note that the strategy is really basically speculating or investing on the density that the underlying S will be at K in the future. So maybe shortly, let's go through what the derivation is doing. Now, the first thing is, intuitively here, you see these are all approximate signs. You see that if you have that strategy, so you go short the call at K, but you go long at K plus delta K and K minus delta K. So you're basically long on that ST, or you make money if ST is in this range of K minus delta K and K plus delta K. Yeah, so that's what the butterfly, usually the butterfly, the way it's, the payoff profile is kind of drawn something like this here. Yeah, so you make money in this narrow range here, and this is the range of K, and this is plus delta K, and this here is then K minus delta K. And And the new insight here is that we haven't also had this valuation part, which is going to come. So for now, just take it as a word from the professor that that this butterfly strategy is picking up the probability mass between k minus delta k and k plus delta k. And this probability mass can change across time. Yeah? If there's new information coming in saying there's a disaster happening, so the probability in the center, in this delta k range, will shrink and the tails become bigger. Yeah? So therefore your butterfly will lose. Or let's say there's information that everything is not as bad as we thought, so there's more probability mass moving into this, let's say k is close to current st, so it's at the money, so we're in the at the money range. And if that probability mass becomes bigger because times are thought to be more calm than we thought before, then the butterfly would make money. And then the next integration here is just to make, in order to compute this probability, you had to integrate within this range, or you just make an integration where you evaluate the integrated probability at one point, and then you multiply by 2 times delta k on the x-axis. So therefore, approximately, once again, how I opened the circle, I now close it. The butterfly is a strategy for which you have a price, and based on these approximate signs, the intuition to be transported is that although the price is given by demand and supply, but there's always an underlying thinking of why people demand these contracts. And here you see that although it's a price, you are really trading a probability that S in the future will be at your K. And therefore, if time moves, there's new information coming in. Now you think, oh, S will be far in the tails and not at the current K, which I said by assumption, let's say, is at the money right now. So therefore, this probability mass shrinks and the butterfly strategy loses. So again, here on this picture, this might also look like a butterfly, so I'm benefiting from if ST will stay in this range here. Okay, the reason I have it here again is it's highlighting that the price of an option relates directly to the probabilities of the underlying. And it's forward-looking because these are probabilities coming from the valuation. So these would be Q probabilities. So these probabilities contain risk premia, therefore they are biased, but still they contain the current information about the underlying. The student was asking in the break, so remember, if you just buy an option, just like we buy a stock and you hold it, you will lose all of the money. This is what research shows. You cannot just make buy and hold with options. This will not work. So with options, you really have to invest in information that you have. And that is what therefore we are so interested in the probability that is priced in. Okay, as I said, this is repetition of what I said in this morning. So if for the butterfly strategy, if you make the delta k go to 0, you really end up with the true mathematical Breeden-Litzenberger result that the f, which in my case here was the q, or here in general it's the probability, that the stock price in cap t will be at k, is the second derivative of the call price on the position s equals k. Okay, so I'm calling that a free lunch. This is not what literature says, but I call it free lunch because what I refer to is if we want to compute a Markowitz portfolio, or if we want to do supervised learning, and we want to predict S, or we want to do reinforcement learning, optimal portfolio decisions of the agent, then we should use that information. That's this free lunch thing. Because we have option prices available, the computation to the density is it's a deterministic transformation of it, so we should use it. In worst case, it's not informative, and then our learning routine would tell us not to put weight on it. But the literature so far, which is moving in this direction, is confirming in the big majority that this is very informative information. Okay, now I want to move on. This comes up next slide. Yeah, I want to shift gears towards something from industry to provide you with a balanced view that what I'm providing you with is really state of the art also in industry. So there's a research ECB bulletin, so it's not a research paper, it's like an industry report, 2020 in April, or issue 4, I'm not sure, maybe it's most likely it's the 4th issue in the year. And it was about the coronavirus. And they had a title for the, maybe it was a 3/4 page paper, so you can find it on the internet. And it was about market fear as implied by options. So there I want to spend some time on it here. So first of all, you see what they are doing. The source is author's calculation and Refinitiv. So from Refinitiv, they get the implied volatilities and then they do the computations the way I've presented it. And you see here nicely the source and the note. These are risk neutral, so Q densities of future returns backed out from the daily price of calls and puts traded on the Euro Stoxx 50. And you see they are computing this density. It also has this nice shape. Yeah, you don't want this zigzag thing. And they have it for different days. This is prior to the COVID, then outbreak COVID, and post-COVID most likely. Yeah? And you just see, you can work with these densities. It's like a microscope, yeah? Because now you can see what is the market pricing in. And I have a few copies, or I have copy of a few paragraphs, which I think I want to go over. So here they describe risk neutral density in their own words. Yeah? The risk neutral density of an equity price is the market's estimate of the probability density function for the future level of that equity price, adjusted for the presence of investors' risk aversion. So it's related to what I said. Yeah? Risk neutral is the Q, and it's an estimate, or it's a predictive signal, for the density function of the spot market underlying. Okay. Q versus P, they are connected. This is going to come later in the course. And they are connected through risk aversion of the investor, basically. Yeah? So intuitively, you can think about if the investor is really scared of that thing to happen, then they buy these put options. And if they buy these put options, implied volatility gets really large, much larger than the realized volatility in the spot market moving forward. Yeah? So therefore, risk aversion will come in, and I talk about risk aversion, risk premia interchangeably, because we know from the CAPM that risk premium is the result of risk aversion and risk, right? My favorite CAPM formula is not the beta formula, but it's this one here, the expected return of the market minus risk-free rate in the CAPM is risk aversion times variance of the market. So therefore, risk aversion and risk premium, it's the same thing. Yeah? They did the risk aversion. If that is 0, then there's no premium. Okay, and then they continue. The risk neutral density therefore reflects both the risk attitude and the price expectations of investors. Okay, that's also what I said, but I use the term biased. I say Q is a biased estimate of P, and bias means there is a shift. And that shift in our thinking is the risk premium. But in the big data and data science age, it doesn't matter, because we will not use Q as, that's why I call it predictive signal. We just put that as a covariate, as a predictive signal in our machine learning routines. So if there is a bias, it would get cancelled out, so it's not a problem. But here it's an ECB report. They don't do machine learning. They just want to work with the density and want to say if the density got, let's say, less tail risk, then there was less risk premium for tail risk. That's their argument. So they need to make the user aware of this bias. Because the critique could be, I mean, the way I said, there's no critique. It's about when they say the tail risk shrinked, therefore we had less risk. Someone could say, we don't know, maybe just the risk premium shrinked, and we have two quantities and only one observation, so we can't tell what it is. Therefore, they have this starting paragraph. Keep in mind, Ms. Lagarde is reading that, yeah, so she should understand what this is, and therefore they are proposing that here. But the text is very like in any research paper which would talk about it, so it's a very good paragraph. But for us in our bachelor's class, it might be a bit too much. That's why I'm trying to add so many additional insights here. Okay, so risk neutral density can be thought of as the physical density, so that's the P, whose shape has been modified in order to give more prominence to those states of the world that are associated with a particular adverse outcome. Okay, and such have lower marginal utility. We haven't talked about marginal utility, so I don't want to do it here, but maybe slightly at least. I think this point is intuitive. It's exactly what I said before. There is a probability here, let's say this probability mass here makes up 5%. But if the investor is so scared about it, he or she might price options where this 5% probability is magnified by a risk premium, and then it's priced maybe with 10%. This could be. Yeah? It has just to add up to 100%, so there will be some shrinkage in the probability somewhere else. But this can really happen, and this is how you should think about if implied vol is 80%, while at the money vol is at 20%. Part of it is because of jumps in vol, but another part is risk premium in volatility. Risk premium of these low tail risk events. And in order to separate them apart, we would need a model, which we don't have here right now. So therefore, I just mentioned there are always these two determinants for, let's say, a rise in left tail option implied tail risk. Either the actual probability of left tail goes up, that's the P, or risk premium goes up, or both. And we cannot tell it apart if we just observe the option implied density. Therefore, if you go back to the very first slide of today's class, I said risk metrics either P or Q. What we do in our database, and you can work with that, so therefore I mention it again, we are using intraday spot market return variations to compute the P risk. So that's the best you can do, right? So, because we need a second density if we want to talk about risk premium. And you will see these guys at the ECB, they use a gauge on the S&P 5, on the Eurostoxx 50 to compute volatility. So they have the same thinking, but they use a slightly easier approach instead of using intraday. Okay, so they say, and just this marginal utility, the point is just, you know it from economics, so I just repeat that. If there is a state you're really afraid of, you have high marginal utility, right? If someone gives you $1 in that state, you will be very happy. So that dollar has a high value to you. So there's how economics comes into the picture here. But for now, I abstract from it. So we derive the risk neutral density of future returns from the daily price, puts and calls. On any given day, these options are available for more than one maturity, and making it possible to estimate the density of several forecast horizons. Okay, it's exactly the way I did it in the morning. The next thing they compute is they want to compute a tail risk aversion indicator. Again, it's a policy paper. So they want to compute some proxy for aversion against tail risk. And here's what they talk about. An indicator of the investor's risk preferences or risk aversion can be derived by comparing the risk neutral density with an estimate of the physical density of returns. Now, I like to think about the CAPM. I go back to this board here. One can show theoretically that the Q density should have an expected value if it's in the return space. So what's the expected return? It should be the risk-free rate. Yeah? So therefore what the CAPM, assuming you know about the CAPM, since we covered it, I can punch it here and there to squeeze out some additional intuition. I like to think about the CAPM as being the A being risk aversion for variance. Yeah? So here I have variance risk. This is risk aversion for variance risk, and this gives me the premium for variance risk. Yeah? And in the CAPM, the only risk thing is variance, because Markowitz has just mean variance, so there's no thinking about skewness and kurtosis. But this one is the expected return under the P density, the actual in the spot market. And this is the risk-free rate, but mathematically, theoretically, I can connect the risk-free rate to the expectation of Rm under the Q measure. Yeah? So therefore, you see already within the cap M, you will never read that somewhere like that. But here, I can just do it. Because I try to connect back as much as we can to stuff we have covered. So the expectation of Rm is risk-free rate. For now, you don't know why this is the case. I just put that as a fact for now. But the reason I'm doing that is to say already the cap N tells us that if there's risk aversion for variance, and now I multiply by variance, then this gives me the risk premium for variance. And for computing that risk premium, I could argue I'm also using the P density, and I integrate Rm with regard to P, and I'm integrating Rm with regard to Q. Yeah? And if we, usually in the earlier master's courses, we spend several weeks on doing that theoretically sound, so maybe I have one lecture at the very end where I would also formalize that. When I did the slides, it's the first time I'm teaching that stuff, so therefore I still have to learn whether the sequence here is perfect. But we have to start somewhere, so I start with the data part. Right, so therefore the overall statement they provide is also correct. An indicator of risk preferences, yeah, because there's also risk preference, or risk aversion is when we compare the risk neutral density to the physical. And I wanted to show you already, this exactly happens in the cap M for variance risk. But now they care about tail risk. So the risk neutral and the physical densities are related to each other through the pricing kernel. That's something that relates to risk aversion, which embeds investors' risk preference. Okay. The physical density, so that's the actual risk in the spot market, represents the investor's best judgment about probabilities of future price developments. Okay, this makes sense. Expectations of physical densities cannot be determined from market prices, as market prices also embed risk preferences. You know that already from the dividend discount model. If you consider dividend discount model, ST is a function of expected dividends divided by discount rate. If the discount rate is a random variable, which it is, then you cannot learn unambiguously about expected dividends by observing the price. Right? Because the price goes up, it might be because the discount rate drops or expected dividend goes up. And it's the same thing here for the options. Because the option also depends on risk premium, which is part of that Q density. And therefore, I personally feel fine to take this density as my proxy for the P density. I know enough that I'm saying this would be okay for me, right? But theoretically speaking, and this is what they talk about here, there is the P density, which we don't observe. There's Q, which we observe from options, but it's biased by risk premium. And now, typical thing, what they do here, researchers have turned to statistical methods to estimate such densities. We use a daily multivariate gauge. Yeah? So basically, I don't know what's multivariate there. There's no more explanation, so I would assume they take a Eurostoxx 50 time series of returns and fit a gauge to it. Right? And that way they make a forecast about vol, then they multiply it by a shock. They don't say it's a Gauss shock or it's a T shock or whatnot, but that way they generate a density. We've done something in our previous modules as well. So yeah, RT equals mu T minus 1 plus sigma T minus 1 epsilon T. So maybe here they didn't specify, so let's say they take an AR1 model, but it's daily return, so they have a mean of 0 basically. So I would assume they take this to be 0, and then they fit a gauge to filter or to learn the sigma T time series, and then they don't talk about that. You need an assumption on epsilon T, yeah? Maybe Gauss, maybe it's bootstrapped, I don't know. You see, it's a policy paper. It's not 100% clear how they do it. Ms. Lagarde will not ask all these questions that I'm asking. But that way they also generate a density. about the EU Stocks 50. And now they have two densities at hand. One used backward-looking data of the EU Stocks 50. They get a density, it's the P. And the other one is from an option price on a specific day they care about across different strikes. And they create a Q. And now they have two densities, and now they can compare the tails. Yeah? So from the gauge, maybe I have some density which looks like this. And then I have another one from the option which looks maybe, I don't know where I always go up here. Yeah, maybe it looks like this. And then I could specify, maybe I want a minus 10% standard deviation shock. So then I can compute this probability mass in relationship to this one. And this is a tail risk measure. So it's well done. Yeah? Just some of the details are not really clear, but otherwise, that's why I put it into the program. I think it's very, if everyone in policy would make such an analysis, this would be really great. So this is what they do. And now here is, let me just keep reading, or before I read, let's look at the picture, since it's about the picture. So in yellow, you see this is the COVID period. It's February 2020 to April. And in yellow, it's the value at risk 10%. And in the caption, I can read it's the value at risk from the gauge. Yeah? So the yellow is the realized, or it's the gauge implied value at risk. Yeah, so I don't mind about the units, I don't care, I just see it's flat here. Then lockdown in Lombardy, so kind of COVID is in Europe, yeah, but you see it takes time, backward-looking data. At the spot market, it's still rather calm, the 10% value at risk, so it's the lowest 10%, left tail. It doesn't move, and then it goes up. It would be nice to see how many days it took. I don't know, you can check at home, I need to look at time. And then you see here, over time as COVID, as the news talks more about COVID and everything, yeah, also the realized tail risk that we estimate with the gauge is rising. And then at some point in time, also here, later than this last column we talk about in a moment, then it also falls. And relative to the yellow, you have the blue line. And the blue line is this tail risk aversion. So it's the ratio of these two things here. Yeah? It's option-implied tail risk relative to the gauge tail risk. You could call that risk premium or risk aversion. Yeah? It's the same. Because if you're risk averse, you're willing to pay a premium for it. And that's interesting, kind of, before, there's no statistical significance here, yeah, but I always work with a linear smoother, so it's rather flat, maybe it goes slightly down, I don't know. And then you see, that's exactly why I love these option data so much, there's an immediate response. Yeah, so to the students' questions from the break, why do options, you just see the option is directly after the Lombardy. The option traders, they go and they say, okay, if you want to buy a put option in the deep tail, it costs you 10% more. And people are like, okay, because I want protection. So in the spot market, you haven't yet seen evidence for rising left tail risk, but it's already priced in. Yeah, and that's why that's predictive information. If I were to plot just the red, it would look like the blue, because blue is red divided by yellow. And we see yellow is flat, blue is rising, so it's because the option-implied tail risk has been rising. Yeah? It's these out-of-the-money put options, they became expensive suddenly, yeah? And they kept rising, yeah? Kept rising. And for the ECB, it was important, they put some policy measures into place. These are the columns here. So there's an ECB APP and an ECB PPP, so you can just read that. I don't care for that right now. But this is the goal why the ECB cared for option-implied information, because they want to get a real-time, forward-looking estimate about did it help what the ECB was doing. Right? So the ECB then argues that although in the spot market risk was still rising, the tail risk aversion or the risk premium measure has been falling with the first ECB measure put in place. Yeah? So therefore, the ECB says we did a good job, which of course, if you say I did a good job, it's always. But let's ignore that for the moment. So there's data evidence that there is a correlation, at least, between what the ECB had been doing to calm the market with the actual risk aversion. Right? You cannot really change the risks, but you can change the pricing of the risks by changing risk aversion, changing the risk premium, and it seemed it really worked. It went down pretty fast to pre-crisis levels, while in the spot market risk was still high. Now that's really cool, but it's also something. There's a second notion to that. You see, options are useful here for this prediction something's going to come, but you also have to think about if you now predict the spot market. The prediction might not be perfect, but I think if we have a non-linear prediction model, it will work it out. Because here the option market would kind of predict that vol is low, but it's still high, still above average. But I think maybe I just make it too complicated here, because I think I have a counter argument, which is we really reversed back to normal, so therefore the expectation would be also the spot market reverses back to normal. And it did. Okay. I think I've interpreted that pretty well. So I can jump over that. You can read that, but it's exactly what I've said. Okay. So maybe any question to that COVID thing? Isn't that surprising and pretty astonishing?
It's surprising.
Yeah, it is, right?
What would be such a measure? For example, are there generic measures that can be done in such situations?
That's going to come now. Right? That's why I like to start with the policy, so you really see what the ECB guys did, and they just use a gauge. What means just? Just doesn't mean only, yeah? But they use a gauge like we had in the class. They could have used the SVM and the Kammernfelder, the same thing, and then they compare with option-implied. It's really nice to go with these 10% valued risks. You can compute that, even you had a problem set on it, so you really see how the stuff we're asking you to do is highly, highly relevant. It's really not just to fill your time, but these are the essentials for really good work. And the bulletin is really done by good researchers, which are very good at the ECB level. Good. So now we move on, and I give you more intuition on what other measures could you have used. And I put that into the milestone of a microscopic view into the future. So we have our database, what we did on a high level. We started in 2014, and we wanted these implied vol surfaces, and then we want to be highly accurate. That's why we did this cross-validation. We wanted to have it in real time, so it had to be fast, and we wanted to have it at trade frequency, which in literature is usually end of month. Some things are end of day, but nothing is intraday. So we have it also in intraday. And then we looked at what were the top publications in terms of risk metrics computed out of the vol surface, and we included that. So to your question, then we included the probability of a 20% down move in the underlying. They could have also used that. But you see already from using a gauge, you cannot identify the probability of a crash. So therefore, I don't know how they could have done better. Because in terms of options, I show you some other metrics, but the question is then always, what's the analog in the P density? And we had student projects 2 years ago, but it's not yet in our database, where we thought about how can we create other risk measures out of a P density, because it's not obvious. And we just tried to mimic what we have in the option, but we could not mimic probabilities of jumps, so crash probabilities. This is difficult. But I just show you what the literature has, and we have it in the database. A lot of the text now is just a redundancy given what I said before. But again, it's for you, so you can read that in a self-contained way. But I cannot read through everything in terms of I have to focus on what is really new and important. So first, I prepared the material once. We went to a conference to an industry meeting with the SIBO with our implied vol data, right? We wanted that they take it, of course, and use it. So therefore, this is kind of where the slides were from, at least how they started. So we asked the question, why care about option-implied information? I think by now I made the point. Research has shown smart/good information moves in option markets first because of the leverage in there, so you get more bang for the buck, and that information therefore should be used for spot market. And a typical asset manager is not using that. So therefore here I'm saying modern risk and asset management should base their decisions, be it a forecast or a decision, so reinforcement learning on that type of data. Okay, from time to time I have a few pictures, but yeah, it's so hard for me to go over them. This was from the research paper with Konstantin Merbex. And just to give you a bit of an intuition, does it matter which option-implied information data provider you use? And we say, yeah, it matters, but we haven't yet done sufficient supervised and reinforcement learning algorithms to judge whether the algorithms can cancel out the noise or not. For now, we just know our measure is the least noisy, that we know from cross-validation, that's like the blue. And we know the competitor, that's like what literature is using, is option metrics. It's also started with a PhD thesis at, I believe, NYU, from a guy who worked at JP Morgan in the 1990s. And before that, Berkeley University was offering such a thing, and then they stopped doing it, and then option metrics came. And what you just kind of see in terms of, this is like skewness for short-term options. You see option metrics here, the skewness is rather close to 0. And their kurtosis is close to 3. That's kind of what we learned, and also to the student. The option metrics vol surface is just a different way of interpolation, and extrapolation basically makes your density be Gaussian. But they have a high cross-validation error in the vol surface, so it's wrong. And ours is here blue. So you see on average it's negatively skewed, and the kurtosis is above 3. Yeah, so that's so I think what I think happens is but we are having some applications on that, but you are the new generation, so you can work on that in the future. But an open question I have, just repeat it again, is you can have a noisy signal and your algorithm is able to cancel out the noise, which is in theory working. But I think with our low signal to noise ratios, this will not work. So you want to have signals which are least noisy, I have the feeling. Okay, so then it's about the volatility surface. I talked about that, so that I can skip over. You even see I have these pictures. That's why on the weekend I thought let's talk about the pictures in more detail and how we construct everything. Okay, then this is an overview of IVS. I've also done that. Maybe just something new. So with Konstantin, Lukas, and Simon, we've been cross-validating. So therefore, if you work with our data, you can be sure it's the most accurate. Yeah, that's good. Then this paper is interesting, not for the vol surface itself, but I've mentioned that once. So once again, you see it's a top econ journal, American Economic Review, 2012. So they were the first to really test and show it works to take options and based on put-call parity to extract the present value of dividends that are paid out in the underlying between now and maturity. And I also put that in here because this is a game changer in a way, also showing using option information to extract inputs you need for the spot market, like pricing dividends. And then they have the generalization. I showed you the picture last time where they also use put-call parity to extract the risk-free rate that markets are pricing in. So you just kind of see the zeitgeist goes towards using that information for even stock market stuff. Okay, then I can save some time. Go to the next slide. Okay, now we did compare the one-dimensional kernel smoother to other approaches. So for you it's just high level, right? That's why we don't have an exam on that. This would be too much. It's just really in German sich mal berieseln zu lassen. Yeah? So the idea is how else could we compute the Q density? Now one way which I found very appealing. That's why we did that at first, but then we learned it's not accurate. So you use basically observed options and you confront them with theoretical option prices. And the theoretical price comes from a model where the density of the underlying under Q is given by a Gaussian plus, and then you have Taylor expansion to include the skewness and the kurtosis. Yeah? So it's very intuitive, it's very well known in other science disciplines. So I like the idea you really learn the density by fitting an option pricing model that depends on the density. And Bébert, he was professor, then went to it doesn't matter, I don't have time for that. And Brandt, he has his own hedge fund. It's very interesting to look for the guy. He's a Duke professor, and these two guys I've mentioned here, who in 2012 really, in my view, changed the way of thinking. It's the same Brandt here, and this one is his PhD student, and he's now full professor at Wharton. Yeah, so they are very successful, but they're also very good. And Coyne is also full professor in Chicago now. And he was a postdoc at that time. Right. And I saw this Brandt once present. He was really good. I mean, yeah, this was... so that's kind of research we also try to do. It's theoretically very strong, but then they are very close to the market. Where's my next page? Here. Okay. Okay, this I want to spend a bit of time on. There's a paper by Figlewski. Yeah? He's professor at NYU, very famous for implied volatility, and he wrote like a policy paper, let's say 2008, about how to construct an implied vol surface. So that's also how we started when we started really doing that around 2012. And there are a few snapshots I took out of the paper. So I talked a lot about these things, and now I'll just show you a few pictures. For example, here. These are observed. Let's go to the spline interpolated call price, put price. Yeah, so option price. So you would have option prices here. I would assume these are out of the money puts, and then here you have out of the money calls. But the point is, their interpolation is the way we would do it usually, right? Point by point. But if you then translate to the density, to the student's question, what is a not nice looking density? This is a density here, density. And you don't want to work with such a density. This is just, you can never integrate that to get a variance or a kurtosis, skewness. The numerical routines, they say, please go back and give me a nicer shaped density. Right? So this really the takeaway. You cannot trust, that's why I go back to the Kalman filter. You cannot trust every point. There's noise around these observations. And they're not using the Kalman filter here, but the learning point is, therefore we then use the kernel smoother. You don't want to put full trust in each observation, yeah? But you want to take whatever's closer, has higher weight, but you allow for deviations. So that I think is a really useful picture. I would not have anticipated that first time I saw it. Then in his appendix, so it's a very nice paper that he has there. He also has a snapshot of a day. And for example, here you see that, but you saw it already in my slides, that the implied volatility for calls and puts is different. And here even for the at the money range. So the pictures I showed you, it was indistinguishable on the chart resolution. But here it's different data set. You see it's a 10% relative difference. So it's pretty large. No? And the question is, what do you do? And there's no math for that, just engineering, so trying. So what we learned from him, he kind of, whenever this happens in the at the money range, he's using a weighted average. So, okay, I wanted to share this. So his density looks like that. So of course we follow the literature. That is now nice looking. Yeah? So you really see there are no extra spikes and the like. But you see clearly the left tail part. And the way he computes that is, again, these boxes always give you the summary of what I've been saying here. So he is allowing that the smoother is not going precisely through all the dots. But you want extra smoothness, yeah, in the wall surface. So what he says, he fits a fourth order polynomial with one knot at a moneyness of k equals f. So in the money range, he trusts the data, but the data is a weighted average of put and call implied vol within a specific range. So it's not, yeah, that already is a proxy. So it's an average, but then this is trusted, and the others, the polynomial can deviate from observations. Yeah? And it will deviate if you have more than 4 observed dots, and each dot is implied vol. Okay, right? And he said you need at least a fourth order to ensure a third derivative, which then translates into a smooth R&D. Because again, the second derivative of the call is the density. If the density must be smooth, it's because the second derivative is smooth. And to have a second derivative being smooth, he argues you need a third derivative, a continuous third derivative of the spline. Okay, so I think the takeaway there from engineering perspective is if you want your output to be smooth, you have to think about how smooth do your transition steps have to be to ensure that. Okay, and then what he does, and we validated that, it's nice in theory, but we didn't find it to be too useful, but I see it quite often in literature, so it has its place. So it's very interesting. I think you might also like it. I've mentioned that the calls and the puts only trade in a narrow strike range, so therefore the at the money range is highly accurate. But if we go to the details, there's little information. In our database, we do extrapolation. Yeah, this was our idea. It works better. And what he does is also interesting just to know from an engineering perspective. Let's say this is the last strike for which he observes the option, yeah? And then he observes another option for here, and maybe the same for here and for here. So while we did use the regression in the wall surface, what he does here is he uses these last 2 points, and then he fits a parametric density just to the tails. That's what he calls with GEV, so generalized extreme value. So if you look up in the statistics book, they usually always have a chapter on these. It's the generalized extreme value density. Yeah? But the intuition is nicely also displayed in the book, that what he observes is the 92nd and the 95th percentile in terms of call price, and he observes the 5th and the 2nd percent. The others are not observed, but he uses then these dots to generate here these tails. But in our cross-validation, we learned that this parametric shape is not realistic enough. Right? You would do better if you just follow the flow in the wall surface, linear extrapolation, and then translate it back to the density. So we spent years on making it 100% for us, so therefore I think this is really a shortcut on our journey. Okay, what else do we have? Then we have a non-parametric. Okay, so the spline of Wiglewski is also called semi-parametric approach. And this one was a parametric approach with the density. And as you expect, parametric is less precise than semi-parametric, which is less precise than parametric. So I think this, than non-parametric, I apologize. Although the spline is sometimes pretty accurate. Now, the entire literature started with Ahit Sahalia and Low, 1998, for that density, also to give you a historical perspective. Now, it's a Journal of Finance paper, and they were, I say, among the first to propose to use a kernel smoother to approximate these implied volatilities. And what's interesting is they used a full year of implied volatilities to construct one density for that year. Yeah, 1998. So they had a robust density for 1997 or for 1996. So we've come a long way that I now tell you we could use it on a tick-by-tick level. So there's a lot of engineering progress on that niche that happened. But the overall structure, you see, this is their three-dimensional kernel. So you take here the vol that you observe, Black-Scholes implied vol. That's the one you want, because you want a dense grid, and therefore you use what you observe, and you are weighting what you observe with how far away is what you observe from what you want. Like you want a tau j, but you only observe different tau i's. Yeah? Therefore you have one kernel who is putting a weight on that distance. And the Gaussian kernel here is e to the x squared. So if the x, which is tau j minus tau I, if that is 0, then the kernel is e to the 0. So it's 1, basically. Yeah? So you have, this is like something which will cancel out through, it's common to all of the kernels here. So you kind of see, if I observe an implied vol for exactly these characteristics, then I will have a weight of 1 on that one. And this is this Ahizahal-Low kernel. Yeah? So Ahizahal-Low, he's at Princeton, statistics professor, and Low is MIT, finance professor, and he also runs, not sure his own, or he's part of different hedge funds. So they are, at that time they were like the best of the best, yeah, in this financial econometric working. And then option metrics, yeah, kind of, they did their project around 1995, 1998, 2000. So they started with state of the art, which was Ahizahal-Low, and they've adjusted that. And there's one difference, you see. They have one kernel across 3 inputs, while these guys had a kernel for each dimension. And in our cross-validation, we learned that one kernel across 3 inputs is not good. In theory, you would think it's good, right? Because you say, I can learn something for this if I observe that. That's the theory, right? Because this maps back to the calls. So I could say a deep out of the money call has information about deep out of the money put, but the way I phrase it already, you see, it might not be the case. Yeah? And you can just find that via cross-validation. And we found this is not good. Because it's a higher dimensional problem, and you know that from operations research. If you go higher in the dimensions, then you better have a lot of data, because otherwise it's just wrong. And that's kind of what we find. The data is not sufficient to identify that properly. So therefore what we did is then, this comes later. So we have our one-dimensional kernel. So you also see how research works, right? You look what's done in literature, and then you try to understand it and make it better. Okay, yeah, you can look at that at home, but maybe I pinpoint just to one thing. This is from our research paper of 2020, and these are root mean squared errors out of end of day cross validation. So it's like out of sample. Yeah? We are leaving out a point, build a surface, and then compare how far is the left out point. And you see we are standardizing the error to 100%, and this is our method. So we are at most at the 100%. Sometimes spline is better. And here, if you look, for example, the most important options, I would say, are short-term options in the left tail. So it's this guy here. And there you see option metrics. Yeah, it's 1,000%. So the volatility of the error is 10 times larger, which is a lot, because it's unnecessary noise. So if you price options, that's a problem. But now I have the data science perspective. It's a problem as well, because there's a lot of movement, which is just noise, has no information, but might look in a small sample exercise as if there was information. And you also see Gram-Charrier. This is this parametric thing. This is the worst. It's a typical thing. Parametric density is not flexible enough for agile data. Okay. And this also was interesting to the referee once we submit that to the journal, because there was no literature on does it matter which wall surface you use. Yeah? People just worked with the wall surface, and you see here, for example, for long-term options, we compute Bakshi moments, and this is now Bakshi implied volatility across different wall surface interpolation tasks, which is completely boring. you might say, but then you see that the average forecast for a long-term option on the index has, if you use Figlevsky spline, it's 27%, while ours would be at 22%. And Option-Metric is very similar to us here. So these are big differences, right? If you price option with 27 or 22%. So therefore, I'm very optimistic for using or for offering to you the database for doing machine learning work. Okay. So, okay. Yeah, I also need to say a word here, since we did that with a student. This was our first successful thesis with a student that resulted in a publication in an A journal. So this was really great. The paper was called Implied Volatility Surfaces, a Comprehensive Analysis Using 500 Million Option Prices. So we had Konstantin. He was in a similar course, but it was on the master's level. Slightly different course, and we paired him with Lukas. He's constructing this entire database in a high-performance environment. So Lukas computed everything in C++, all the different methods at different frequencies, but here it's end of day. And then Konstantin in Python, he generated his cross-validation pipeline, which Lukas told me is very sophisticated. And so we were the first study ever because usually everyone looks at the index, yeah? And then we just said, no, we want to look at all the 500 constituents, and each of these option volatilities, end of day, which are 500 million, how is 500 million? 500 million. We took each of these prices and cross-validated them. So you see, it's something you can do at the KIT, right? First, because you need the proper students, you need the proper data, and you need the proper IT infrastructure, because that's a big data thing. And for me, what it really also showed is there was a clear division of labor, because we couldn't have done it without Konstantin, he couldn't have done it without us. So it was really great. And yeah, the C++ here and the Python there. And he even did an internship in between. So it was really, we went through everything there. But it worked out great. So we have this very simple kernel, basically. We have implied vol observed. This is what we want for a specific moneyness. And you see, we just have one kernel in the moneyness dimension. That's what we do. We do extrapolation. I've mentioned that. It's not a big killer, but it helps. But you could even survive without. But we like it, because the literature usually puts it flat. But again, as a data scientist, you need to look at the data. So if you see the points are like this, of course you see here some rounding, but the probability of the next observed to be flat is basically 0, right? If you look at the data. And that's what we did also with Simon a few years earlier. So we do this extrapolation, and it reduces the root mean square error, I think, by 15%. So it's not the major killer. The big killer, which really reduces option metrics error by factor 10, is just having one kernel here. Which is also, I think, a KIT thing, because Simon, he did the work with experimenting all of the specifications. And then you see we want real time, it needs to be fast. So in theory, you open a book and they say you have to optimize over the hyperparameter h. But time is money, right? So we don't have time for that. Imagine you want it on a tick level, which was our goal. As Simon always said, it doesn't work, but now years later, it works. So therefore, we have a rule of thumb, but also the experimentation, why it works, as Simon did that. Okay, so just since it's our work, I spent time on the abstract. The study delves into the critical aspect of accurately estimating single stock volatility, a task indispensable for option pricing, risk management, empirical asset pricing, which now is a data science machine learning. Utilizing a comprehensive data set consisting of 500 million daily price observations for 499 individual stocks and the index, the research investigates the accuracy of diverse methods for constructing the vol surface. The comparatives are option metrics, Figlevsky spline, and we find volatility, and a refined one-dimensional kernel smoother. So we improved on our original one. The method consistently outperforms its counterparts across all moneyness, all maturity, and all liquidity categories. So that's why even though as a scientist the glass is always half empty, yeah, I'm rather bullish. So the method consistently outperforms all its counterparts with lower error metrics. For example, this is then we send it in. Bakshi was the editor of that journal. Again, you see how literature works. So then Bakshi, of course, he knows his paper, and he asked us in a revision to redo an exercise he did with 1 million option prices. He tried to run like a CAPM regression for skewness. He asked the question whether the skewness of a firm can be mapped into the skewness of the market plus some epsilon. Yeah, and he didn't have so much data than we had. So he wanted to know whether the different vol surfaces come up to different conclusions. So I think this was a very nice point because it comes to the point where that noise matters for further analysis. So we then redid that with Lucas, since Konstantin was already working by then somewhere else. So the study further uncovers significant distortions in the extractions of Bakshi moments and skewness spanning induced by the noise infused by the three-dimensional kernel smoother, which could potentially mislead derivative pricing and traditional decision making. So therefore, I think so. The point one is noise matters. If you have noisy input, of course, your output will be noisy. This is a problem. We are in a low signal-to-noise environment, so we need to make sure the input is not noisy. And for you, since we're the new generation, it really means. Also, I have to say this in German. Mit diesem Datenset kann man sich halt richtig austoben. Ja? Because it's so big in both the time series dimension, if we consider high frequency, and in the cross section, and in terms of accuracy. Because what you don't want is run a big analysis with imprecise data. Then it's just rubbish. At the end of the day, there's the sentence: "I did everything correct, but nothing works." But it's not the problem of the algorithm, it's the data. So here we are, for now, very bullish on the accuracy of the data. So the findings offer valuable insights to traders, risk managers, investors, researchers, suggesting a robust, one-size-fits-all method for crafting more accurate and less noisy volatility predictions. The research advances our understanding of option-based information, its extraction, and broader implications for financial markets. Okay, so this was as of last year. We've tried to redo that with our intraday, but there we had a PhD student who half-time worked in industry, and the PhD student was from mathematics, so I was not used to working, did not succeed. I'm not sure we have a project right now or not. I think there is a computer science student, he was at a symposium, he's now KIT Computer Science, ETH Zurich master thesis. And he was interested in a fast-track PhD, and I told him, your first project would be to rerun that stuff because we have the infrastructure with the intraday. I mean, this is a big animal because already Lucas says this was big. And of course, if you have high frequency, this is interesting. This is a big thing. So we try to do that. This would be really great, but I think the solution would be the same because we have in Walter already, we have some intraday, and there our algorithm was better, and in our internal, which we didn't publish, with our filtering, we reduced the error of our previous method, intraday, by factor 10. So it's just a huge improvement. So I'm so sorry we don't have a paper out of that yet, but the devil is in the details, and we don't have a cross-validation exercise. So here's the spanning regression Bakshi asked us to do. So you see again, has nothing to do with CAPM, but for me it's like a CAPM thing, because I ask whether skewness of firm N is related to the market skewness, and by how much in terms of R square is beta significant. And you see, if you use our vol surface, this is blue, which is most accurate, you have here the T statistics of the beta. And you see there is quite a bit of betas which are below -3, so they are significant. Also here significant. If you use the option metrics database, which 90% of literature is still using, you see most is within, I mean, everything is, it seems, between -5 and 5, so it's hard to get any significance in that regression. So I'm very bullish if we use these predictive signals for supervised and reinforcement learning, that it is as good as it gets. Okay, bless you. Yeah, so we have 10 minutes to go. I think we are well in time. I have 15 slides, but there's a lot of text which we already had. So I just bullet point that stuff. So implied vol extraction was always known since the 1970s. Now extracting the full density, we are kind of the first, and our strategy is now we make end of day public, the database, and intraday we still try to get some alpha on that. So here's how you get the density and the like, and maybe I just want to magnify this picture here. It comes up again. These were just some quick. The question is, you have a big database, how do you validate a database, right? So we validate the volatility surface, but still, this is statistically good. But then you try to find hard things. And what I came across was the flash crash. So it's interesting for your GPT. 2010, May 6, the market over lunch dropped by 10% and then went up again by 9%. Yeah, everything within 30 minutes. So this is a big sweat period if you are having a trading book at that time. And you see here, these are timestamps, 2 o'clock, 00 minutes, 5 seconds, and 3.27 milliseconds. And this is the blue density we get. So it's just beautiful. In a sense, it's not the sweat of the trader, you don't see it in the densities. So therefore, I think the densities are robust. They are pretty good, and I just compute here skewness, kurtosis, and you can compute all the other moments. So I think it's ready to go. And that's why I want in the last problem set is reinforcement learning. And the last, I believe, 2 classes were set for reinforcement learning. I might take away 1 class for the Q versus P. I think this might be important. But we want to introduce you a little bit to this reinforcement learning, because that is something, I think this will be our new thing, given we have the wall surface. We have Ardalan, you know him, he's from electrical engineering. So they are good in optimal control, or very good. And reinforcement learning is an optimal control problem, right? So it's like flying the rocket. So you need to know what's going on, that's the density, and then make optimal decisions. So I'm very bullish on that. And it's really cool because no one's doing it. It's so difficult to do, right? Because first you need the density, and we spent 10 years to make it. And it's even not 100%. We don't have it yet, everything in C++. So, but we are getting there. Yeah. So, what's the next page here? It's the same thing. I talked about this, so I can jump over. Here is just for you at home. You could, if you ask yourself, why is little q the second derivative? You can see it from the valuation. So I just pinpointed, yeah. The price of an instrument is the expectation under q. You don't yet know why. That's why I will make this extra session, I believe. Yeah? But for now, take it as given or double check with GPT. You don't need that in your problem set, so it's fine. But the point is, I have material also on the YouTube channel where I derive the Gordon growth model under P and under Q. That's a very useful exercise because you see the price can be computed under both. The question is just whether the risk premium is explicit in here or implicit in the Q. Because you see there's no risk premium here, yeah? But the risk premium is in the Q. Therefore we say ECB paper, Q contains the actual probabilities and risk premium. Okay, but otherwise, so you have an expectation which is just an integral, and you see that's the Q we want to extract. So you can do that at home. If you build the second derivative, you are really isolating out the Q. And this is so cool, right? I mean, it really is, because there's no machine learning necessary. It's a simple looking. We need a model, because this is also a model, I would argue, because at the end of the day, the price is demand and supply, but investors are not stupid, right? They are very knowledgeable. So this is little theory, I would say. This is like a hard fact. And then it's simply working with the derivatives to get the Q out. And that's why you see, maybe one more thing, which I like as a student, the max looks really complicated and fearsome in a way, right? What's the max? But then you see the integration, the max disappears because you simply integrate where the K is, where the S is above K, and for all the rest, the integral is 0. So I like that insight when I saw it the first time. I forgot where I got the source from. I computed that once. No, not me. I saw it from some robo-advisor or whatnot, and I thought it's interesting. They also already work with option-implied densities. So this is really something which is worth covering even in the bachelor's, which university like Mannheim, they would make this in the PhD maybe, yeah, if at all. But that's why, so you see the difficulties in preparing the material, teaching it, but then also, I think for you, the engineers, this is really doable. And therefore we don't have the exam, because for the exam it would be an overkill. Okay, 3 minutes to go. This I already showed. These are the densities, these are that I talked about. Here is one example. In our database, we have like a skewness, and then we decompose a skewness into the systematic part, idiosyncratic part. We don't have any research yet on that. This is all for the new generation. But the idea is like in the CAP-M, you have the realized return, and you decompose the return into the systematic part. Oh, I don't have it here. With the data and the idiosyncratic part, but I think you know what I refer to. And you can do the same thing with skewness, kurtosis, and we go up to the moment 10. Yeah, we have 10th moment. Yeah, so I just jump over that. But again, we use this CAP-M type intuition, just run a regression. This allows us to get the beta, and once we have the beta, there's a math formula how that translates into the cumulants. And then instead of moments, we work with the cumulants. During your problem set for next week, you have some time to do some research on cumulants versus moments. I have it also on the slides coming up here. This might also be from Wikipedia, I'm not sure. Yeah, M are moments and C are cumulants. So statistically, sometimes it's more pleasant to work with cumulants. And we once had a very bright student, Bayesian estimation of these complicated models. And the standard errors in the estimated parameters were too large for us to use. This was such a pity. And then 1 year later, I discovered that the cumulant, that in these affine jump diffusion models, the cumulants are linear in the states. And then you can use Kalman filter. And then the parameters are less noisy. Because a linear filter is much easier than a nonlinear filter, given limited amount of data. And by then, this is now then the second example here where I learned that the cumulants are so useful because you know that the mean is linear and you see the mean and the cumulant 1 are the same. You also know the variance is linear and you see the second cumulant and the variance is the same. But then with the third cumulant, it's not the third moment anymore. But the cool thing is that the cumulant of Monday plus cumulant of Tuesday is the cumulant of Monday to Tuesday. While the third moment does not add up. So the skewness on Monday plus skewness on Tuesday doesn't give you the skewness from Monday to Tuesday. So you have always to compute via the cumulants. This is some details, but just for the engineering part, you've heard that if you come across in another class. So you see really, there's always a solution to it, and really we didn't see it at first. Okay, so therefore we are using the cumulants up to order 10, run a CAP-M regression on each cumulant basically, firm versus index, and that's how we decompose every cumulant, and then we compute it back to every moment. So we compute every moment into firm-specific part and market part. That's also interesting, you know, if you run a prediction, let's say, on individual stocks, now you just you don't only have, let's say, one skewness number, you always have two. The market part and the idiosyncratic part. So I don't know even ex ante which one is predictive. I don't know. Then one more thing. I think we have 2 minutes. No, we don't. Maybe one more thing for the P moments. Here I just want to highlight the way we compute the P moments in the data is not like ECB with the gauge, but we're using intraday data of the spot market, and we use the Bundy algorithm. So there's a bootstrap involved, so we use that. We believe it's the most accurate. And here I want to mention the source here is from SIBO. SIBO was also now, it allows you now also to trade skewness. Yeah, it's like Bakshi skew. This is so cool because as a researcher, I was long a student, of course, and then you always have, and yeah, sometimes you were like, I don't know, yeah, but if you suddenly see that stuff as a financial product, then you really see there's a very close connection between the academia and industry. And so you can trade skewness. It looks a bit like the the interest rate futures I said last week. It's 100 minus 10 times the skewness, and this is Bakshi skew. So it's just cool. So you can trade on it. The next thing for sure will be kurtosis. Okay, and maybe one last thing: the CAPM usually you are told it doesn't hold in the data, but Wilkoff and Bus, Bus was PhD Frankfurt, where I was also, and Wilkoff was a postdoc there from INSEAD, and they do option-implied betas, and they compute option-implied betas by using option-implied vol, and then correlation is the problem, so they have some model for that. But here you see the red curve. Firms, or they have quintile portfolio, so a portfolio with a higher beta on average pays a higher return. Yeah. So therefore, let's be bullish on the CAPM. It most likely holds. It's just always a data problem. And then in our database, we also compute option-implied betas, option-implied expected returns, and the like. So I'm out of time. I'm really out of time. Just want to note you to Martin, we are not covering that in our class, but he has this lower bound on the equity premium. It's very interesting. It's really interesting because he brought newly to the table that the expected premium is really time varying. And I truly trust in that, I have to say. It's like the CAPM, A times sigma square is the risk premium, right, in the CAPM. And SVIX is a measure of sigma square, basically. So I think intuitively makes absolutely sense. So I think this can change the Markowitz way. Then the colleague asked about tail events. That's why I just go very quick over. We have several tail crashes. You can read about that. And then there are different papers who try to quantify that. Analytically, this is far too much to talk about, but we have it in our database, right? And then you can compute stuff like mean left jump intensity of a 7.5% jump or 20% jump. Yeah? Future machine learning applications need to prove whether it's of worth or not. That's what I want to end up with. Thank you for your patience.